Secrets of returns risk can ruin your retirement plans, but a reverse mortgage could save the day. But how? In today's video, I'm going to discuss exactly what sequence of returns risk is and how it can be a danger to you running out of money in retirement. Now, I'll be discussing a published study from the Journal of Financial Planning that asks the question, HECM as a last resort versus using in coordination with your portfolio. And I got to say, the results are mind-blowing, so definitely stay tuned. If you're new to the channel, my name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, Florida. I'm a licensed loan originator. I'm in this chair each and every day helping families buy homes, refinance homes, and reverse mortgages are our focus of our practice. Just go ahead and leave a quick like in this video. I certainly appreciate it. And let's go ahead and get into it. Okay, so what exactly is sequence of returns risk anyway? But before we get started, very important, let's talk about disclosures, okay? Let's get all the disclosures out of the way. I'm not a financial advisor, not a tax advisor. Prior performance is not indicative of future results. You consult your tax professionals and financial professionals before executing any kind of financial plan. I'm licensed for the mortgage part only, guys. Just to be clear about that. My license is only for mortgage brokering on the reverse mortgage. So everything else, consult with your advisors for your own personalized scenario. So consult your tax and financial advisors for anything. All right, are we good? All right, let's go and get into it.
Okay, here we go. Let's talk about the sequence of returns risk and reverse mortgages. Okay, so what exactly is sequence of returns risk anyway? Essentially, it means the order in which the good and bad years occur during the distribution stage of your retirement. Okay, so they can have a powerful impact on how long your retirement assets will last. Any market volatility at all is going to hurt, but if it occurs in the first 5 years after you begin taking income, there's a significant chance that you can run out of money much faster than you planned, and your account just won't have enough time or years to recover. So this is from Kiplinger. Okay, so about exactly what sequence of returns risk, and today we're going to discuss exactly what sequence of returns risk is, and you can kind of see some different examples in that study I told you about. Okay, so here's a pretty good graphical representation. So when sequence of returns risk happens, it's like getting on a flight, taking off, and finding out mid-flight you don't have enough fuel. Shortly after takeoff. So you can see here is your life expectancy, and then here's your money. So that's kind of a good representation about what it is. Basically, you running out of money before the end of your retirement. And so here is the study that I mentioned. It's reversing the conventional wisdom using home equity to supplement retirement income. And this is from Drs. Barry Sachs and Stephen Sachs in the Journal of Financial Planning. And their methodology, they use over 10,000 Monte Carlo simulations. And effectively, that's what they use in the financial industry to model different theories. And I guess it's an algorithm, and you can Google what a Monte Carlo simulation is. But effectively, they ran different iterations to test their theory. And this is kind of what they found. So they demonstrated the benefit of a coordinated HECM strategy versus the conventional wisdom of HECM as a last resort, which is unfortunately what a lot of the financial industry has over the years considered reverse mortgages as something off to the side we do at the end or when we need to as a last resort. And today I'm going to talk about how that's maybe not the best way to look at it. Okay. So what they did is two options using a HECM line of credit. So you use a HECM as a last resort. You go through your portfolio, or use a HECM in coordination strategy with portfolio withdrawals. So here's the assumptions. Basically, you started with a value of $400,000. Inflation-adjusted withdrawals are 3.5%. Okay, so your home value starts at $495,000, and then over the years, we're going to look at a 30-year time span, ending home value $1.2 million or so, about 3% average appreciation. And the logic is a retired couple, $27,000 annual Social Security income, and the goal is maintaining a lifestyle that costs $53,000 at the beginning of retirement and adjusted, inflation-adjusted withdrawals. Okay, so here's how it looks. I'll leave this up for a while. And again, getting back to the disclosures, illustration purposes only. Past market performance does not reflect future results. I'm not tax advisors or financial advisors. This is just looking at a certain period of time. Now, they chose to look at the years 1973 through 2002. So again, past performance does not indicate future results, but it's helpful to look at a 30-year time span that had a lot of volatility through here, guys. So you can see, the bear market of the 70s into the, Black Monday, into the recession of the 90s, into the dot-com bubble. So you had a lot of volatility and good market ups and downs. But they chose this time frame because it had the very definition of sequence of returns risk. You had a 1-2 punch here in 73 and 74. Boom, boom. So right away, -11, -15. So that's kind of what happens here. And you can see over the years, your portfolio withdrawal is $26,000 and goes all the way through, but you can see you run out of money in 1998. And then you say, okay, well, let me get a line of credit right away so to supplement my income, and that's what you do at the end. So, okay, so what are the results? Portfolio value is 0, so you run out of money, effectively. So the result, your portfolio is exhausted after, year 25.2. You're 5 years short of life expectancy. Portfolio value is 0. You have your home equity still to leave to your estate. Okay. Option number 2 is to look at, your HECM in coordination with a portfolio withdrawals. So what you do is you establish a home equity line of credit. Not a HELOC, but a HECM line of credit. Let me be very clear about that. They're two different things. Prior to the first day of retirement. So day 1, you give me a call. We get you a line of credit. We get you a reverse mortgage line of credit, and then we establish it right away. Now you evaluate your portfolio performance at the end of each year. Okay, so you say, well, if you're up, you take the next annual draw from portfolio. If you're down, you take the draw from your HECM line of credit, assuming there's funds available, of course. Okay. So it's what happens. Again, same assumptions: $400,000, 3.5% inflation-adjusted withdrawals, withdrawal rate of 6.5%. So again, $495 value, ending $1.205 million. Same logic: retire couple, $27,000 annual Social Security income, $53,000 lifestyle to start with. Okay, so what are the results? So you can see here in 73, 74, you take that 1-2 punch, boom, boom. But at the end of those years, instead of taking from your portfolio, you take a line of credit draw. So meanwhile, you have your funds still in your portfolio. They're down, but they're invested still. They're not withdrawn out at the wrong time. And that happens the first 2 years. And you can see the drastic effect of having, and you only did this really 2 years, 74, 75, and then 91, and then 2002. So 4 different times did you ever have to use your line of credit. And then over the years, that line of credit will grow based on your interest rate and the FHA mortgage insurance. But again, with this scenario, you only had to use it 4 times effectively. So what did that do to your portfolio? It left your portfolio over $1 million versus 0. So why? Because the strategy enables you to consistently leave more money in your portfolio. With any financial advisor will tell you that's very, very important. So you're not taking out money at the wrong time, hence the sequence of returns risk. Okay, so let's compare the results. HECM was last resort, 0 portfolio value, no assets. You have an estate. You have your estimated home value minus the total borrow from the reverse mortgage, $730,000 leaves your heirs. It's not nothing. It's okay. But let's look at the HECM coordination strategy. So again, from 0 to 1.02 million, plus the home value minus what you borrowed, you leave 1.6 million to your estate, guys. It's just night and day difference about what a HECM coordination strategy could do to mitigate sequence of returns risk. Okay, so let's, what if you have a lot more money? And I'm trying to break that paradigm that reverses our last resort. Like, what if you come in and you have a significantly larger portfolio, significantly larger home? So we're going to take a look at that. So there's proprietary reverse mortgages that my lenders offer, called HomeSafe. And so for this scenario, you have an initial value of $2 million. You're still 62, and you come in, and then what you do here is that you get a max line of credit, with initial cash at close of $307,000 and $319,000 max line of credit. So many of my clients will take cash lump sum first, and then have a line of credit that'll grow. That's a very common scenario. And it's the same one, initial draw for expenses until depleted, coordinated strategy. And we've already shown that doing the last resort strategy will result in 0. And it's the same thing here. But this is kind of goes to the end here. And again, here's 73, 74. You have your 1-2 punch, boom, boom. So you have that $307,000 that you use. And, that's just the initial one. You use the initial disbursement. And then you still have that credit line of $319,000 that grows each and every year that you can use for negative portfolio performance, in-home care. You can, help your kids buy a house. It allows you some flexibility, meanwhile keeping your funds invested. So again, you come in and you end up at $2.865 million. So it's kind of the same thing. HECM was a last resort. $0. Versus estimated home value at the end of $4.854 million. Your estate is $2.7 million, guys. It's not nothing. But again, with a coordinated strategy using a reverse mortgage line of credit, as well as your portfolio balance, it's $5.6 million, almost $3 million more. So again, show this to your advisor. Have him run it, and again, all the scenarios. But just a good, peer-reviewed study in the Journal of Financial Planning about how you can use reverse mortgage. And definitely, if you have any questions about this, give me a call on the reverse mortgage side. Show this to your advisors. Let's get you into this strategy.
Well, now that you know more about reverse mortgages and how they can help your portfolio, you may have a question about what's the difference between a reverse mortgage line of credit and a normal HELOC. If you watch this video here, you can check out what the differences are.